All right, so let's talk about the 5 commonly misunderstood money truths that I think everyone should understand. By the end of this video, you should better understand how these truths can be used to build your long-term wealth. All right, the first one, less is more. You don't actually need a large number of material things to be happy. For many of us, it's actually the other way around. The fewer things that we have, the better off that we are. If you've ever cleaned out your closet one day, where you just take everything out and only put back those things that you really need, you'll likely be surprised at how many things you really don't need. For us, my wife and I recently did this to prepare our home for guests staying with us over the next few months. We decided to clean out each room and just get rid of anything extra that we just haven't used in a while. After a few days of this, we both realized that we felt better about getting rid of things, whether through donating or selling them, than we actually first felt when we acquired that item. It's kind of backwards. If you order just one thing per week online, just one thing, that's over 50 plus things per year. And if you're like we were at one point, us as a family, you're ordering way more than one thing. You're actually probably ordering one thing per day. Those material things just build up and likely don't bring you much happiness. Focus instead on accumulating wealth that you can then spend on experiences or other investments in the future. If we could go back and do it again, we'd likely cut out a ton of these random Amazon purchases, put that money saved into a savings account, and then spend it on a vacation or let it invest for the long term. That vacation would have probably brought us more happiness than the accumulation of those material purchases. Not all debt is equal. Debt can come in many forms, so don't just lump all debts together, right? Instead, you should better understand the different types of debt and then know which ones to avoid and then which ones you can actually use to build wealth. For most types, it really just starts with the interest rate that the debt is charging you. And then from there, it starts with credit card debt. Credit card debt typically carries the highest interest rate of all types of debt. Most people think about credit cards as bad, but the key here is that you only pay interest on credit cards if you don't pay off your balance in each month. If you're paying it off in full, you never need to worry about this. And you can use credit cards to accumulate rewards that can genuinely add value and happiness to your life. We put all of our expenses on credit cards and then set up automatic payments for each credit card so that the balance gets paid off in full and never carries over to the next month. This way, we never pay any interest, and then the money we spend actually helps build up rewards. These rewards, they cover almost all of our vacation through airline and hotel points. When looking back over the last few years, our time spent on vacation definitely stands out as some of the best memories. So for us, spending on credit cards really worked out. Now I get it, there's a flip side to this. And the flip side of that is if you spend too much money on credit cards and you end up going into debt, you'll start to pay a lot of interest and potential fees on that debt, and it carries over the next month. If you can't pay it off one month, the interest then starts to compound on top of the principal balance. And then the next thing you know, you're in credit card debt. Trust me, I've been there. If you're worried this might happen to you or it's already happened to you, credit cards may not be for you. Stick to using only available cash for spending through your debit card, or just use physical cash so you don't get into more bad habits. Student loan debt is another example of something that actually allows you to obtain higher education that you might not otherwise have had the means to do. It's no fun to pay it back after college, but that college degree could get you in a better position for higher lifetime earnings. That might be a great investment right there. A mortgage. A mortgage is another type of debt that can be really used to your advantage. Not many of us have the type of cash savings to go out and buy a home, especially if you're in states like California and New York. A mortgage can allow you to purchase a home and then build wealth through the equity in your home if that's what you want to do. So while home buying is certainly not for everyone, so I get that, a mortgage can be used as a means for accessing capital you would not otherwise have in most scenarios. But wait, before we go to the next one, if you're enjoying this video, hit that subscribe button and turn on notifications so that you get notified for more of our content. We provide high quality content like this every week, 2 videos a week usually. Your money in your back pocket is gonna thank you. All right, next one. Building credit is important. Credit matters because it can determine your access to financial tools that help in building your wealth. You may not think about credit in this way, but go ask any millionaire or someone who's really successful, and I bet there's a good chance that they use credit to get there. Credit gives you access to credit cards, loans, lower insurance premiums, and the better the credit score, the more favorable terms that you'll likely get for these tools. But if you have a bad or no credit history, some companies like utilities and cell phone carriers will make you pay a big deposit up front to cover months worth of your plan. A credit score is a 3-digit number, typically ranging from 300 to 850, that defines how likely you are to repay borrowed money. In general, there are credit score tiers that you may get bucketed into when your credit is run. A score of 720 or higher is generally considered excellent credit. A score between 690 and 719 is considered good credit. Scores between 630 and 689 are fair credit, and scores of 629 or below, that's poor credit. And with that, there are 5 main factors that make up your credit score: payment history, amounts owed, credit history, new credit inquiries, and then types of credit. Payment history and amounts owed together make up almost 65% of your credit score. So let's just focus on that first. Focus on building good credit by simply making every single debt payment on time and in full, and then keep the amount that you actually owe to a minimum. If you have a student loan or mortgage, I get it, you may not be able to have a ton of control over the amount owed, but you can focus on making every single payment on time and in full. If you have a credit card, set up automatic payments so the balance is paid off each month. Also, avoid spending too much of your available credit. If you're using a high percentage of available credit, the creditor sees this as a red flag. A good rule of thumb here is to keep your total amount owed below 30% of your total credit limit. If your credit limit is $10K, for example, and you end up spending more than $3K in a month, you would go above the 30% limit and then temporarily hurt your credit score. So use credit to your advantage. Retirement plans are important. I get it. When you're in your 20s and 30s, retirement seems way too far away and you just don't feel the need to worry about it. Planning for something 40 plus years out just seems so unnecessary when you're young. However, ask anyone that's nearing retirement, I bet you they'll tell you they wish they had more retirement savings. No one wants to downgrade their lives when they stop working. You want to set yourself up to travel more or maybe even retire earlier. For many of us, our 20s are when we have the fewest financial obligations and expenses. Try to take advantage of the amount of time that you have ahead of you by starting earlier. The earlier you start, the more time your retirement savings have to compound. And compounding right here is huge for retirement savings. To put this into perspective for a 401k, say you make $80K per year, and then we assume your federal and state tax and withholdings all totals about 30%. Each paycheck after tax ends up being $2,333, meaning that's what you actually see hit your bank account every other week. If you withhold 10% of your paycheck into your 401k, assuming the same 30% federal and state tax brackets, you'll get paid $2,042 each payday instead. That's only $291 less each paycheck, but adds up to an additional $8K in 401k savings each year because the 10% withholding is taken pre-tax. If you factor in the power of compounding, this really adds up over 40 plus years. Roth IRAs are another great tool for retirement planning. You can contribute up to $6K each year into the Roth IRA, and then your investments grow tax-free. If you wait until you're 59 and a half to withdraw these funds, you won't owe any taxes. But if you need to withdraw them sooner, you're never taxed on your contributions, and then there are a lot of exceptions to avoiding taxes on the gains as well. It can be overall a great resource for younger investors still eligible to contribute. Side note, you can also potentially use your Roth IRA funds for a first home purchase. Now, if you max out your Roth IRA contributions and then still have extra savings left to invest, you want to consider investing in a standard taxable brokerage account. There aren't any tax advantages to this type of account, but there are also not any types of restrictions when it comes to withdrawing your funds. You can use this type of account to save for that future home or just a more general way to build wealth. Taxes don't have to be scary. Taxes make so many people worried, and the word taxes seems to cause a lot of anxiety in so many people. But it doesn't actually have to be that way. You can actually use taxes to your advantage. In general, taxes are calculated based on the amount of income reported to the IRS, which then gets calculated through a line item referred to as your adjusted gross income. So if that's the case, your goal should always be to reduce that line item, adjusted gross income, because that then reduces your taxes owed in most cases. If the amount of taxes that you pay during the year through withholdings is more than what's calculated when filing your taxes, you get a tax refund. If it's less, you owe taxes. With that understanding, if you can build wealth while also reducing the amount of income subject to tax, that's a win-win, right? Well, there are actually some legal, keyword, legal, basic ways to do this, so it isn't that complicated. The 401k is one great example. Pre-tax funds withheld from your paycheck get set aside in your retirement savings. These funds then do not count into your adjusted gross income and therefore don't get taxed. You can simply set aside more money here, let compounding do the work for you long-term through investing, and then reduce some taxes while you're at it. If you're a 1099 worker or self-employed, you might be able to do this through other investment accounts such as a SEP IRA. A SEP IRA allows you to contribute funds that then reduce your taxable income. Funds in the SEP IRA grow tax-free, just like your 401k. If you use an investing service that does automated tax loss harvesting, you can also use losses generated from this service to offset income or other capital gains. You just need to make sure that you're using a service that does this automatically every day without you needing to go in and manually do anything. As a matter of fact, I have just the service in mind. Check out the link below. All right, I'm Tony from Wealthfront. Thanks so much for watching. Share it with one of your friends.